What if you could spot a trend reversal one period earlier than most traders? This advanced price action trick, the combined pin candle, takes the confusion out of market shifts, using just two bars to confirm a powerful rejection. By combining this unique two-bar pattern with our simple EMA 21 trend filter, you gain a high probability entry system, letting you execute clear trades with confidence and minimizing your exposure to noise. Mastering this combined pin candle puts the control back in your hands. It's the next step towards stable, consistent, and stress-free trading in any major market. Let's dive in. Welcome to this advanced guide on a high probability system, the combined pin candle in trend with EMA 21 strategy. This method builds on our core pin candle idea, but uses a powerful two-bar pattern for entry. It remains a simple and clear strategy, ideal for beginners, offering high probability setups and the benefit of low operational stress, especially if you have limited time to monitor the markets. The recommended time frame remains the daily chart. Trading on the daily chart provides the clearest signals, ample time for analysis, and effectively avoids the stress of fast-paced intraday trading. For experienced traders, alternatives like the 4-hour or 1-hour chart can be used, but be prepared for quicker decision-making. The only indicator we rely on is the exponential moving average 21, or EMA 21. Its role is simple and vital, confirming the trend. The rule is firm. If the price is above the EMA 21, we are in an uptrend and only look for long trades. If the price is below the EMA 21, we confirm a downtrend and only focus on short trades. Our entry signal must always occur at a key level. We only trade where the price has reacted significantly in the past, such as clear support, resistance, or previous bounce zones. This level must be immediately obvious. Trading at these respected areas drastically increases the probability of a successful reversal. The heart of this advanced method is the combined pin candle. This is a powerful two-candle pattern where the two bars, when merged, create the visual effect of a single, decisive pin candle. The combined range determines the maximum and minimum, while the relationship between the two closing prices dictates the small resulting body. This pattern is a sign of strong market rejection over two trading periods. These diagrams visually explain the merging process. In the first example, the combination of a red bar and a green bar creates a resultant candle with a long lower wick. Note how the highest high and lowest low of the two bars define the total range. In the second example, the opposite occurs, resulting in a bearish pin with a long upper wick. This clarity in the resulting shape is what qualifies the pattern as a high probability signal. Let's detail the specific conditions for a long position. As always, you must meet all criteria. First, the price must be above the EMA 21 to confirm a clear uptrend. Second, we wait for the price to pull back to a key level. Crucially, a combined pin candle pattern must appear, specifically showing a long lower wick. If valid, the entry is placed just above the highest high of the two-bar pattern, and the stop loss is set securely below the lowest low of the combination. Here is a practical long example on the EUR-USD daily chart. The trend is clearly defined as the price is trading above the EMA 21. Following this momentum, the market executes a necessary pullback, moving back down towards the support area, which in this case includes our key level and the EMA 21 itself. This forms the perfect setup location. Now we have our signal. Notice the two bars that form our pattern. A red bar followed by a strong rejection, green bar. When combined, their range shows an extremely long lower wick. This is the failed attempt by sellers. Crucially, the resulting body of the pattern is small and closes near the top, confirming that buyers have definitively regained control and signaling the end of the pullback. We zoom out one last time to confirm the confluence. Notice how the combined pattern is not random. It formed precisely at a clearly respected key level that previously acted as both strong support and resistance. This confluence of a confirmed trend, a tested level, and the pin candle signal is what validates this as a high probability trade. Finally, we set our execution plan. The entry is placed just above the highest high of the combined pattern to ensure we only enter when the upward movement is confirmed. The stop loss is placed securely below the lowest low of the two bars, defining our exact risk for this trade. This approach ensures maximum precision and risk control. The conditions for a short position are the exact mirror of the long setup. We require the price to be below the EMA 21 to confirm a clear downtrend. We then look for a pullback toward a key level where the combined pin candle forms, this time showing a long upper wick. If this pattern forms at the level with the resulting body closing near the bottom, we place the entry just below the pattern's lowest low and the stop loss above its highest high. Let's analyze a short trade example on the GBP/USD chart. The price is clearly below the EMA 21, confirming a strong downtrend. The market then executes a corrective move, our required pullback, up toward the key level resistance area. We have established the optimal environment for a short entry. The two-bar signal forms exactly at the level. We see a green bar followed by a red bar, forming our combined pin candle. When mentally merged, the resulting candle shows a long upper wick, meaning buyers were strongly rejected by sellers at that resistance point. This clear rejection is the core of our high probability signal. We zoom out to confirm the strength of the resistance. The combined pattern is forming right at a key level that has been repeatedly tested as resistance in the past. The confluence of a downtrend, a respected level, and the combined pin candle signal is the necessary confirmation for a valid setup. For execution, we place our entry just below the lowest low of the combined two-bar pattern, ensuring we enter only once the downward momentum resumes. The stop loss is set securely above the highest high of the pattern, defining our maximum risk with precision. For position management, our rules are simple for maximum consistency. We recommend a minimum risk-to-reward ratio of 1:1. The target itself is flexible based on the movement's strength, giving you the option to use a trailing stop to follow the trend and maximize overall profits. Knowing when to stay out is essential. Do not trade if the combined pattern results in long wicks on both sides, which is a sign of indecision. Also, avoid trading if the resulting pin candle is poorly defined, or if the key level is not clearly obvious, or the pullback is too shallow or too deep. If the overall situation isn't clear, don't act. The quality of the combination is critical. Here, the pattern is invalid because the two candles lack the necessary visual structure. The body of one bar is not clearly contained within the range of the other, and there is no clear alignment between the opening and closing levels. This ambiguity prevents a clean pin candle from forming, resulting in a poorly defined signal that must be avoided. In this example, the resulting candle is flawed because the short wick is too large relative to the long rejection wick. Here, the rejection dominance is too weak, and the market shows too much interest in moving against the trend, signaling an unreliable setup. That successfully concludes our guide to the powerful combined pin candle strategy. If you found this content valuable, please support the channel. Leave a like, share the video with your trading community, and make sure to subscribe and activate the bell so you don't miss any of our next strategies. Before you go, let me know in the comments below. What are your thoughts on this combined pattern? And which price action pattern should we explore next? Thank you very much for staying with me until the end. Keep studying, keep improving your skills, and always follow your plan. Happy trading.